Good afternoon and welcome to this session on the transition from LIBOR, practical consequences. Many of you who know me will be aware that I've spent a lot of time over the last couple of years wrangling with the challenges that is LIBOR transition. And as the deadline at the end of the year for cessation of LIBOR rapidly approaches, I'm very pleased to introduce you to a person that I've probably been spending more time with certainly than he'd like, which is Doug Laurie, who is Director and Barclays LIBOR Programme Director. So today, Doug is going to discuss some of the practical consequences of transition on cash management in particular, and what treasurers should be doing now. Just as a reminder, you're all familiar with the platform now, so please do ask questions as we go along, and I'll ask Doug as many of them as I can get to at the end of the presentation. So over to you, Doug.
Good afternoon, everyone, and welcome to today's session on the practical consequences of transitioning from LIBOR. So in today's session, we're going to try and cover a number of things. So first of all, the background of what happened, what has happened, why it's happening, and when are the key dates that you need to focus on. The second thing is looking at the difference between LIBOR and risk-free rates. Then we'll go on to looking at what is happening in the major currencies and what are the key dates that you need to focus on, both for new activity, and then finally focusing on stop transition and focusing on what you need to focus on this year. So starting off, what is happening and when? And I guess the first key thing here is that ICE or IBA issued a consultation late last year signaling that LIBOR is potentially expected to cease for sterling, Swiss, yen and euro LIBOR from the end of this year, and dollar LIBOR from June the 30th, 2023. What's the consequence? What's the context of why this is happening? Essentially back in 2017, Andrew Bailey, who headed up the FCA at the time, delivered his famous speech on the need to replace LIBOR. LIBOR is being replaced by risk-free rates such as SONIA or SOFR for US dollars. And really what the difference is, a risk-free rate is essentially an overnight rate. It's anchored on overnight activity in the economy, where there is a huge amount of volume, and in contrast to a term rate or LIBOR rate, which since Basel III, which has essentially driven borrowers to, or driven banks rather, to borrow for much longer tenors to bring financial stability in the market, has essentially diminished or reduced the 1 month and 3 month interbank market, which means that the LIBOR market that we use today in loans is essentially underpinned by very, very little underlying activity. So what we should now go on to is, what is the difference between SONIA and LIBOR in more detail? And really the key difference is that SONIA, or overnight rates, are overnight rates which reflect the cost of borrowing from yesterday. So they're backward-looking rates, whereas LIBOR is a forward-looking rate, which reflects the cost of borrowing over a 1 month or 3 month tenor, so looking forward. So today, what is the cost of me borrowing for a 1 month into the future? So therefore, SONIA is a much more accurate reflection of the true cost of borrowing, which is reflecting of, as I go through the month, what is actually the true cost of borrowing that money. But the key downside from a client perspective is that, unlike today, where at the start of an interest period, you essentially know what you're going to pay in interest at the end of the period, with overnight rates, because it's backward looking, you don't know what interest you're going to pay until the end of the period. And what the market has done to try and offset that is to create what's called a 5-day lag, which gives 5 days at the end of the period in order for banks to be able to invoice clients clients to be able to reconcile that and then make payment, so that the way that the market works today remains intact. So how is interest calculated? On this slide, you can see, I guess the conventions from a sterling perspective, but these daily interest amounts are essentially compounded on a daily basis. So to allow clients to continue to pay on a 1 month or a 3 month basis, which is typically how the market works, we take these daily rates and we essentially compound them on a daily basis for a 1 month or a 3 month tenor. And then, using the 5-day lag principle, 5 days before the end of the interest period, all of that compounding is added together to create an invoice, similar to what clients would receive in a LIBOR basis today. And then clients then reconcile that and then pay the interest as they do today. The conventions that we've got outlined on the table there are the conventions that were defined by the sterling risk-free rate working group earlier this year, and just set out a common standard around how interest should be calculated across the market. So I guess we've now covered the core principles of what's happening in the market, why it's happening, and also how interest is calculated. What I now want to start focusing on is what is happening in the different currencies, and why are things potentially moving at a different speed. So what you can see on this slide is essentially all of the major currencies and the key timings for those currencies. So from a sterling perspective, the risk-free rate working group has got a key milestone at the end of Q1 to stop future sterling LIBOR issuance. And this is a key milestone that the authorities are keenly focusing on ensuring that the market meets. Given that we're less than a year away, potentially, from LIBOR cessation, entering new LIBOR contracts at this point in time with no fallbacks essentially means that anyone signing up to that deal will need to do something else before the end of the year before LIBOR ceases. And therefore, this deadline is seen as a key point in finalising the transition from for new issuance and for refinancing away from LIBOR. Now, what we've seen in the market so far is that most new and refinance bilateral activity is already on either Bank of England rates for smaller deals or SONIA today. And we're also seeing very good momentum in the syndicated market too. Looking at some of the other currencies, we mentioned earlier the fact that US dollars is expected to now go out until June 2023. The Federal Reserve has set a target to finish new or refinanced dollar LIBOR deals before by the end of the year. We expect the authorities to enforce that in a similar way to what we're seeing in the sterling market today. But I guess the key message for now is that from a dollar perspective, there is a little bit more time. But given there is an end date to dollars, then it's important that you're considering, if you do enter into a new dollar deals, what potential fallbacks in order so that you have a transition path away from LIBOR. So I guess building that out in, I guess, a little bit more detail in terms of what does that mean across each of the currencies in terms of what do you need to do and when. So obviously for sterling transactions, we've just said that really from this point forward, all new activity really should be on either a SONIA or a Bank of England bank rate perspective. And from a transition perspective as well, people should be focusing on, how am I going to transition existing deals away from sterling LIBOR by the end of the year. As we mentioned, you can continue to use dollars, but you need to think about embedding switch or hardwired language. We have seen activity for dollars in the UK market. So there's a number of high profile transactions, whether that is the Shell deal that we co-led in 2019, or British American Tobacco executed a multi-currency deal early last year, and that there are other deals in the market. So if people want to proceed, there is activity and there is market practice of using SOFA. And typically what we're seeing in the market is that people are using the market conventions that have been set out for sterling, that are set out in the LMA loan agreements across each of the currencies. For euros, there is no end date for Euribor at the moment. ESTA is available for people who want to get a common approach across the major currencies. But at this point, there is no end date for Euribor at this point, though the Euro Working Group are working on fallback. So again, in a similar way to LIBOR, it makes sense if executing a Euro deal to think about fallbacks and to think about the transition if Euribor was to fall away over a period of time. So I guess we've covered a little bit around new origination now. So what I wanted to try and build on now is, I guess, a little bit more in terms of what are the differences between the rates. And this becomes important when you start looking at the stock transition path, which we'll then start focusing on in the later parts of this presentation. So there is a difference, as we've already discussed, between sterling LIBOR and SONIA. The LIBOR, as we know, has got a credit and liquidity premium in, and we know that SONIA doesn't. And therefore, you can see through the graph that one way of transitioning, which we'll go on to the next slide, is looking to use a credit adjustment spread, which looks at the difference between how LIBOR and SONIA has performed over the last 5 years. And what you can see through these graphs is essentially over the last few years, SONIA, LIBOR and SONIA plus this credit adjustment spread, which we'll build on in the future slides, very, very closely follows each other, both for the 1 month rate and the 3 month rates. There are times where they diverge, and that's really a specific time. So, for example, in spring of last year, LIBOR moved substantially above SONIA plus the 5-year historic median. And that was really because, very, very early on in the COVID crisis, there was a huge expansion of liquidity or pull from borrowers to borrow money. There was a shortage of cash in the market, and given LIBOR has a credit and liquidity premium in there, that pushed up the cost of borrowing. However, what we're seeing in the market now is that, certainly for sterling, there is concerns around potentially sterling going negative, and therefore LIBOR is showing the opposite effect. So currently LIBOR is below SONIA in the 5-year historic median, because moving out to 3 months time, there is concern around whether interest rates will potentially go negative at some point. So I think the key fundamental message here is that what the risk-free rate and what SONIA in particular, focusing on sterling, does is it is much more reliable and very, very much more closely tracks the Bank of England bank rate than LIBOR did in the past. Going back to spring of 2020, at that point when LIBOR was going up, the central banks were trying to reduce interest rates and to reduce borrowing costs. And you can see that SONIA followed in a similar way. As the Bank of England reduced rates, SONIA reduced as well. So SONIA is definitely seen as a much more reliable and stable means of calculating interest on a go-forward base than LIBOR is today, because of that behaviour that LIBOR shows. LIBOR shows, at certain points in the cycle, but typically, as you can see, it's following very, very closely, over a period of time, that the two rates combined. So I guess building that out, what the next slide is really focusing on is looking at the economic equivalence to how you achieve the transition from LIBOR to another risk-free rate. And obviously, we've just talked about the fact that there is a difference between the rates. So if we move from one rate to the other without doing anything at all, then there's going to be some form of economic equivalent. There's going to be some form of economic impact, and there will be some form of winner or loser between the parties that are involved in the agreement. And therefore, the way that the risk-free rate working group have looked at this, based on activity that ISDA have done in the derivative market, is to look at how do you measure the difference between those rates. And the way that, or the term which is used on a common basis is something called a credit adjustment spread. And this, in its common form, is a measure between LIBOR and SONIA, and is used to reflect the difference. So the Sterling Risk-Free Rate Working Group recommended in late last year that if you were transitioning a loan from LIBOR to risk-free rate at cessation, the best way to achieve that would be to use this 5-year historic median between the two rates as a means to measure the difference between those that we looked at on the previous slides. And this also aligns to the ISDA protocol mechanism, which is used, across each of the currencies, as a means that if you sign up to the protocol, how assets that are aligned to the protocol will transition at cessation, and therefore achieving essentially an alignment between the loan and the derivative in terms of the methodology and the timing of the transition. There are other ways to measure the credit adjustment spread as well, and people have used other means to do it, but the 5-year historic median is the way that is deemed as, certainly if you're moving at cessation, what you should look to do. I think the other key part to this slide is the fact that regulators are very keen to make sure that there aren't winners and losers. So the credit adjustment spread is there to try and find equivalence, but it's also there to make sure that both parties find equivalence, and that's an important part from an accounting perspective as much as it is from an economics perspective, in order to achieve an equivalence from an accounting standpoint. So this is deemed as a non-accounting event because we've followed an equivalent method which is being recommended in the market. So that said, I guess the next key discussion really is, what are the other things that we need to focus on in the transition? What are the key things that you need to look at when you are transitioning a loan? So the first thing, based on what we've talked about, is really what currencies are you going to deal with, and when are you going to deal with them? So are you looking to transition your existing loan agreement? If it's a multi-currency facility, are you going to move all of the currencies at first? Or are you going to deal with the currencies that you need to deal with in 2021, i.e. sterling, Swiss francs, yen, and deal with dollars at a later point, maybe next year or the year after? The second thing really is looking at, when do you want to transition? So if you've now made a decision of what you're going to do, the next thing is, do you move as an active transition? So renegotiate with parties now, and then transition at the point that you sign that amendment, that you move straight to the risk-free rates at that point? Or do you move at cessation, and so embed that language with the credit adjustment spread in the deal now, stay on LIBOR until cessation and then transition? Or do you pick a particular point in the future, so negotiate now and then pick a date, whether that's September, October time, and then transition at that point? So each bank will have different options or different approaches around the offerings that are there, but essentially those are the key things to think about in terms of what to do. The other factor which I think is important to focus on here is, are there any other products which are involved? So hedging is an important part of this as well. So where clients have got hedging, they will need to consider the impacts of the hedge and whether it is important to transition the loan in alignment with the hedge, or whether those things can be done independently. And what we would suggest is that people should really think about that quite carefully, and potentially even take independent advice to look at those things carefully, and how to transition your LIBOR in terms of how to transition your LIBOR risk. One thing I think to flag is that the conventions between loans and the derivative market are slightly different. So though they are mirrored around the same principles of using overnight rates, because of the need in the loan market to support mid-period events, whether that's a prepayment or in some facilities trading, or the ability to transfer from one entity to the other, there is a need in order to calculate interest on a daily basis, and therefore loans uses what's called a non-cumulative calculation basis, or a daily calculation basis, so that if something happens on a mid-period event, then the agent can work out what interest is due at that point. The way the derivative market works is on a cumulative calculation method and looks at an average over the period. So where there is only one party in the deal, then that works very well. But the challenge is that by doing that on an average basis, if there's no change in the period, then there's no difference. But the cumulative process works very different when you have mid-period events, and it's something that's worth, as I say, looking at to make sure that if it's important to achieve an equivalence between the two products, that you think about that carefully in terms of the methodology and the timing of the transition. So we've now got through to question and answers. So I've rattled through that in record time. Whether that's a sensible thing to do, because that now allows Sarah to ask lots of nasty questions, but far away.
You didn't think that through, did you, Doug?
No.
Okay, we already have quite a lot of questions. Okay, I'll start. I'll pick one off right from the very top. That is a question we get asked on every time we talk on this subject, and doesn't hurt repeating, which is, what is the rationale for scrapping LIBOR?
I think that's a good question. So I think it goes back to what I said, going back to Andrew Bailey's speech before. Post the financial crisis, essentially there are a number of things done in the financial industry to try and make the financial industry more stable. One of those was Basel III, which essentially encouraged banks to borrow over a much longer tenor than they potentially offer in the loan market. So essentially removing this sort of match funding approach that used to work in the loan market. But what that essentially did was to remove most of the intrabank lending which occurred in the market today. So what you've essentially got in economic terms is roughly $400 trillion worth of stuff fixed on LIBOR today across the various currencies, with very, very little underlying activity. And therefore, the authorities see that as a key financial stability risk, that if LIBOR was to fail, it could cause a significant impact, not just to banks and to large corporates, but potentially going right down into the global economy. And therefore, based on that risk, the authorities have looked over a period of time to try and increase the scope of real activity that feeds into the underlying setting of LIBOR. But the reality is today, most of the tenors are really reliant on expert judgments of the banks. And I think the authorities are trying to step away from that and to get back to fundamentals. And the only place where there is a lot of underlying activity is in overnight activity, where people are essentially washing cash into central banks at the end of the day, and that is a vast array of liquidity to essentially to set rates on the back of.
Really helpful, thank you, Daf. And just a question, just to clear up, really. You've mentioned fallbacks several times as you were talking. Can you just explain what a fallback is?
Yeah, it's a good question. So I think the focus on sterling, as I mentioned earlier, should be around now executing new deals on a LIBOR or Bank of England bank rate perspective. But where LIBOR transactions are entered, or when any new transactions entered, one of the key things is to work out what happens if the current or the rate that you're determining to set interest on, essentially falls away. It either ceases or it stops working. What is the methodology to calculate interest on a go-forward basis? Now, as part of the transition effort, one of the things that banks one of the things the market has looked to do is to embed fallbacks or language which provides a transition mechanism if LIBOR or another rate goes away. So in the derivative market, that's been achieved by the ISDA protocol. So essentially a protocol which, if you sign into, essentially embeds language in the agreement which provides you a safety net at cessation. In the loan market, we don't have the equivalent of a protocol because everyone has their bespoke loan agreements, based, typically on LMA templates. So to achieve that, we have to embed on a negotiated basis language. So most contracts, probably for the last couple of years, should have used some form of language which provided initially reduced the vote threshold for making a transition from unilateral to majority consent. And then what we've really seen since October in the sterling market is the use of what's called a switch facility, which allowed clients essentially to neutralize their risk to LIBOR by defining a date in the future when to move to SONIA or another rate, but essentially allowing syndicate members or their own themselves more time in order to get systems ready, and therefore the interest started off, or the deal started off live on LIBOR and then transitioned at a specific point. What I think we're now saying for sterling is that opportunity from a regulatory and a target perspective falls away at the end of March. But that is something that you need to consider if you're entering into a LIBOR deal now, or if you're looking to continue to use dollar LIBOR for a while. And certainly, if I'm looking at from a stock transition, the first thing I think you look at is, what do I have in the agreement? Do I need to do something? Because if you have that switch mechanism in, you could just allow that potentially to happen. But the majority of clients or facilities, in our experience, don't have those types of provisions in, and therefore I base the presentation based on what the majority need to do.
Yeah, no, that's really helpful. And I think what I would add there as well, just as an aside, is that when you're looking at your contracts and understanding exactly where you have LIBOR exposures, it's always worth looking at your fallback mechanism. Some contracts will fall back to fixed rate, which if you do nothing is probably not where you want to be. So you do need to understand exactly where all of the contracts are falling back to. Sorry, it's just a speak from me, apologies. Doug, back to you. Every bank is giving me a different spin oblique solution. How do you address this, particularly with syndicated facilities?
I think that's a good challenge, and in a way, some of that's to be expected, because as much as this is a big change for corporates, this is also a big change for banks, and banks have been over the last year at different points in that trajectory. I would anchor back to what we talked about before, that there are clear recommendations in terms of how a SONIA loan or an RFR loan should work, that have been made by the Sterling Risk-Free Rate Working Group. If you look at the equivalent ARC working group in the US, it's very, very similar. There's a lot of, there's been a lot of, sort of activity in the market now, which I think reinforces that the vast majority of trades have followed those principles that have been set out in the risk-free working group, and also have been embedded in the LMA loan agreement. So yes, I think some banks have been at different points. We're definitely seeing that come together now, and we're seeing much more activity in the syndicated market using risk-free rates. But I think if you're getting mixed messages, I would focus back on what is the LMA template showing, what is the market guidance, because I think that is the point that I would recommend that people start in terms of what they think is the standard, because that is those standards have been written based on what activity was in the market at the time of writing.
Thank you. It's a question, as this is a cash management conference, specifically around cash management, really. So this, understandably, a degree of nervousness around confirmation solutions. There's a nervousness that there's likely to be discrepancies between calculations, just because it's so much more complicated than it was under LIBOR. Is there a way that people can try and address this challenge?
I think it's an interesting point. So what I talked about earlier around the sort of 5-day lag, I think that is really to try and neutralize where possible clients from, if they don't have the systems, from having to do the calculations by the agent bank setting out the rate, sort of the rate at the start of the period, but they're invoicing towards the end of the period, so the client can then see the reconciliation and tie it back at that point. Where people want to do calculations, we know that treasury management systems are embedding this into their system. So again, that should allow a full reconciliation. We have considered, or the market has considered, embedding sort of calculators or means to do this on a simpler basis. The Bank of England look to implement, or have implemented, sort of a index at the back end of last year, but that does not mirror the practices that typically work in the loan market. But we have seen some vendors interested in creating an index and or creating calculators to simplify the process, and I would expect that over the next 6 or 12 months, some of those will come to fruition.
Okay, thank you. Time for one last question. I shouldn't laugh before I even tell you what it is. Why can't I just use the term rate that's now available?
Good question. So I think it goes back to so you're right, there is a SONIA term rate that's been published since January, but I would anchor back to what we talked about at the start. So a SONIA term rate is essentially based on, is calculated today on activity in the swap market. So looking at bids and offers based on activity from the major dealers in the sterling market. So it's more robust in terms of how it's calculated versus an expert judgment type approach where LIBOR is today. However, it doesn't get beyond it doesn't get you pass the point that there is no underlying or very little underlying activity at 1 and 3 months. So though it's more robust, it doesn't address the fact that there's no underlying market. So therefore, I think the official sector see it as a means of providing a solution for smaller clients and certain products, such as trading working capital, where you need potentially forward rates for discounting transactions, for example, or potentially as a transition tool. But what they're keen to do is for the entire market not to move onto a term rate, because then we potentially open up the risk that we just recreate all the same challenges that we've got in LIBOR today on a new rate. So the authorities have been very keen to stress that the use of a SONIA term rate should be limited, and therefore, and having done some user case analysis, which the ACT were involved in, early last year, what was found by the risk-free rate working group is that 90% of activity, certainly by value, could be done on an overnight basis, and that most clients should be able to transition to those overnight rates over time. And certainly for clients that have access, or use bonds or derivatives, having commonality with that market and what was happening on that market also made sense as well.
That's very helpful and the perfect place to leave this. We're out of time, so thank you very much indeed. And thank you to the audience for all the questions. You'll be able to watch this session again on demand. It'll be up on the platform in a few hours' time. So I would just like to say thank you very much and goodbye.
Thank you, everyone.